All right, welcome class. Today, we're going to lay down the cornerstone of your entire business education. Whether you dream of launching your own startup, managing a major corporation, or investing intelligently, you have to speak the language of business. And in this lecture, we're going to learn the single most important sentence in that language. It's the key, really, to unlocking how any company on Earth actually works.
But before we dive into the nuts and bolts, let me pose a question to frame our discussion. Think about it for a second. From a global giant like, say, Apple, all the way down to the local coffee shop on the corner, what's the one common language they all must use to communicate their health, their value, and their performance to the world? And the answer, of course, isn't English or Mandarin or Spanish. It's the universal language of accounting. And today we're going to learn its fundamental grammar, the core sentence structure that underpins every financial story ever told. So here's our roadmap for today. First, we'll talk about what I call the business Rosetta Stone. Then we're going to deconstruct the equation piece by piece. After that, we'll see it work with some real transactions. We'll understand the unbreakable rule that keeps everything in balance. And finally, and most importantly, we'll connect it all back to how you'll use this to make real-world business decisions.
Okay, let's dive in. I call this equation the Rosetta Stone of business for a very specific reason. Just like the actual Rosetta Stone allowed us to decipher ancient languages, this equation allows you to decipher the financial health of any company. It's the key that lets you read the story that's hiding behind all the numbers. And here it is. Assets equals liabilities plus equity. Now, I want you to burn this into your memory. But please don't just memorize it. Our goal today is to truly understand the logic, the why behind it. At its heart, this equation is just a simple statement of truth. It says that everything a company owns, its assets, had to be paid for in one of only two ways, either with borrowed money, which is a liability, or with the owner's own money, which is equity. That's really all it is. All right, so to really grasp this, we need to break it down into its three components. We're going to start on the left side of the equation with assets. In simple terms, this is all the valuable stuff a company owns and controls. Now, the key phrase here, and I want you all to really focus on this, is future economic benefit. This is absolutely crucial. An asset isn't just stuff. It's a resource that the company is going to use to make money in the future. If it can't help generate revenue down the road, it's not really an asset. It's probably just an expense. This forward-looking perspective is fundamental. So what do these look like? Well, they can take a lot of different forms. You have the most obvious one, cash in the bank. But you also have things like inventory, the products sitting on a shelf waiting to be sold. You've got physical buildings, the factory or the office space. And of course, the equipment and machinery used to create the product. All of these are assets. Okay, now let's look at the other side of the coin. If assets are the resources the company controls, liabilities represent the claims that outsiders have on those resources. Put simply, it's what the business owes to other people or other companies. These are not optional. They are legal obligations. Some very common examples you'll see are bank loans, money borrowed to finance a big purchase, like a building. Another one, and you'll see this constantly, is something called accounts payable. Don't let the term intimidate you. It's just the money the company owes to its suppliers for things it bought on credit, like raw materials to make its product. And that brings us to our third and final piece, equity. Now, this one can be a little tricky for students at first, so let's really clarify it. The best way to think about it is this. Imagine the company decided to close down today. It sells off all its assets for cash. Then it uses that cash to pay back every single one of its liabilities, the bank loans, the suppliers, everyone. Whatever cash is left over, that's the equity. It's the owner's slice of the pie. And that's why the formal definition uses this specific term, residual interest. Residual is just a fancy word for what's left over. So equity is simply the owner's claim on what's left of the assets after all the debts are paid. It represents their initial investment, plus any profits that the company has earned and kept over the years. All right, now for the fun part. Theory is great, but let's see this equation actually work. The magic of this system is that every single transaction, and I mean every single one, from selling a cup of coffee to buying a whole other company, creates a dual effect that keeps this equation in perfect, constant balance. So let's build a business from scratch. An entrepreneur starts a new company by investing $5,000 of their own savings. Let's trace what happens. The business now has an asset, $5,000 in cash. Simple enough, but where did it come from? Well, it came from the owner. So the owner has a claim on that asset. That claim is equity.
So assets of $5,000 equals equity of $5,000. It's perfectly balanced from day one.
Okay, the business is off the ground, but it needs more cash to expand. The owner goes to a bank and gets a $10,000 loan. Now let's think critically. How does this transaction affect our equation?
Take a look. On the asset side, our cash account just went up by $10,000. We now have $15,000 total. But we didn't just create that money. We now have a new obligation, a new claim on our assets from an outsider, the bank. So on the other side, our liabilities increased by $10,000. See how that works? Both sides of the equation went up by exactly the same amount. It remains perfectly balanced.
So what happens if a transaction happens entirely on one side of the equation? This is a great example. Let's say the business takes some of that cash and buys a critical piece of equipment, maybe a new computer system, for $7,000. Now, this is a really interesting one. Look closely at the assets section. The total value of our assets hasn't changed at all. It's still $15,000. What happened is we simply exchanged one asset for another. Our cash went down by $7,000, but a new asset, equipment, went up by $7,000. The net change on the left side is zero, and the right side, totally untouched. The equation still balances perfectly. 15,000 equals 15,000. So a good question at this point is why? Why does this always balance? Is it some kind of accounting magic? Well, no, it's by design. It's the result of a brilliant 500-year-old system called double-entry bookkeeping, and it's the engine that guarantees the integrity of all modern finance.
The core idea is simple. There are no one-sided events in business. For every action, there's an equal and opposite reaction, so to speak. You can't just have an asset appear out of nowhere. If an asset goes up, then either another asset has to go down, or a liability or equity account has to go up. At least two accounts are always affected, which ensures the whole story is told. Now, let me point out a very common mistake I see when students are first starting out. In our last example, a student might correctly record that cash went down by $7,000 and then just stop. But that leaves the equation unbalanced. It's only half the story. You always have to ask the follow-up question, what did we get in exchange for that cash? We got equipment. You have to record both parts of the exchange to maintain that logical, unbreakable balance. Okay, so here's the most critical part of the entire lecture. Why do we spend so much time on this? Because this is not just some mechanical bookkeeping exercise. A deep understanding of this equation is the absolute foundation for all business analysis, for all strategic decision-making. This is how you turn raw data into actual intelligence. As future managers and leaders, you're going to use reports built on this equation to answer vital questions. For instance, by comparing current assets to current liabilities, you ask, can we pay our bills next month? That's not just a number. That's assessing solvency and survival. Then, by comparing total liabilities to equity, you ask a strategic question. How are we financing this company? How much is from debt versus the owner's pockets? This tells you about financial risk or leverage. A lot of debt can supercharge your returns, but it can also be incredibly risky in a downturn. It's a trade-off a manager has to make. You'll also look at the makeup of the assets themselves to ask, what resources do we actually have to fuel future growth? Finally, by tracking the equity account over time, you answer the single most important question. Are we actually creating value for the owners? Is their investment, their stake in this company growing? This isn't just accounting class. This is the language of corporate strategy. And that brings us to our final thought for the day. The accounting equation gives us a perfect snapshot, a photograph, if you will, of a company's financial health at one specific moment in time. But as we all know, business is a movie, not a photograph. It's dynamic. So how do we measure performance, things like revenue and profit, over a month or a quarter or a year? Well, that is the very question we will tackle in our next lecture as we move from the balance sheet to its dynamic counterpart, the income statement. Thank you.